So government is shut down. That's impacting the information that we're getting and how we're going to figure out how rates are going to go, because that's what we talk about here, right? What is happening with the interest rates? Everybody wants to know, are they going up? Are they going down? Well, regardless of what's happening in the rates, there's other things that you should be focusing on instead of the interest rates. You can focus on the deals that are out there, right? So let's talk about a deal that's out there. There's one that I've got sitting in front of me right now. It's actually two. It's a pair of deals. So it's very, very interesting with these pair of deals. We've got two houses, one that needs quite a bit of rehab in Tennessee, in Memphis. It's actually a pretty decent neighborhood. I've seen this myself. It's partially rehab, not complete, but the individual who's offloading it, he's got other projects he needs to get done. So he's looking at how to liquidate some things to move into these other projects for opportunities he has in front of him. Now, his other projects are there. He just needs to inject capital into it. So just to understand what's happening in his world. So he has one that is worth about 181,000 when the rehab is done. Presently, he is going to be offloading, and then he has another that's going to be worth about 201,000. Now, there's appraisals in hand to show that. So we're talking about 380, yeah, it's $382,000 worth of property value here between these two when they're completely done. What he is looking at doing is selling one for about 75,000, the other one for about 165,000. Collectively, he won't sell them individually, got to be collective. And then you have the rehab details that he has been able to create. He's got details of 54,000 to finish. One of them has the majority of the rehab. There's only 12,000 to finish. You're just putting in the ACs and the ductwork and you're good to go. So between the two of them, total cost to acquire them from him and then get the rehabs done is $286,500. So that's a chunk of capital. But there's also hard money sitting in the wings, ready to jump in there and help you acquire the properties, get the rehabs done. He's already got the crews lined up, so you can step into that. By the time you're done, 286, you got a $382,000 value. Do the math on that. Look at where that lands pretty quickly. So actually, we'll do it together. Let's talk about this together. So you have a $382,000 value between these two homes, right? And then you have $286,500 that you have to use to purchase this property or both these properties, and you have a $382,000 value. So that puts you at a 75% loan to value combined on these properties. If you do it right, you could finance 100% of it, and you're literally in the deals for nothing. We have to just engineer it correctly, right? So it's going to take a little bit of engineering. Now, it may not work out exactly that because they're both going to be a little bit different, but you're 75% loan to value. If you have a deal like that where you can finance all of it and literally get all your money back out of it, literally have all of it in there, you have no money tied up in the deal, even your 80% loan to value because of costs, you now have two performing assets worth 382,000. You have 20% equity to 25, depending upon your cost structure, and you have none of your personal capital into it. It's almost impossible to calculate that return because the return on investment, if you have a $286,000 in total cost, let's round this up to 295,000 with cost, just argument's sake. I'm sure it's gonna be higher. Let's say it's 300. Actually, call it 300,000 with cost, just for the sake of doing this. And you have, let's say, 20 grand tied up. Let's say I can leave some money in the deal. Let's say $20,000. You divide that whole situation, the $300,000 you have invested, you divide that by 30, which is how many years it's going to take to get your money back, for the tenants to pay it off. That's $10,000 a year they're going to pay off in your behalf. Is really what's going to end up happening. You divide that into the 20,000 you have invested because of the costs, let's just say, guys, that's 50% return investment on your money every single year just by somebody paying your mortgage. That's it, right? So if you're in this deal, again, 300,000, and they're appreciating by 2% per year. Normally go do 2% over the next 30 years, right? That's $6,000 per year on the average. It's going to compound those 2% on the 2% that was added, but we're just going to go with the flat two. That's $6,000, but you have $20,000 invested in the deal, right? You're making another 30% on your money. We're right now at 80% return on your investment on an annual basis. I'm having a hard time seeing where this is a bad gig, right? You're at $16,000 return every year on the 20,000 you had to leave in the deal, and that's a back of the napkin math worst case scenario. So if you're interested in getting into something that you got to do the research though. You got to get the information. I'm not going to give you any of the stuff. I can send it out to you. I can introduce you. What I'll do is I'll introduce you to the guy selling it. I'm not taking anything from it. I'm just connecting two people. I'll introduce you. You can look at all the numbers. You can do the inspections. I'll introduce you to an inspector out there that's a great guy that can look at it and tell you, yeah, this is what's going to be. He'll give you the copies of the appraisals he had done. You can talk to the guy and say, hey, this is reality. Understand it. Know what you're doing. I will guide you through it the best I can, but there's deals out there. So that was a deal that we can talk about. Now let's get into what's going on in the market. So we had, of course, ADP gave us job information, and that had a major effect on the market because of what was going on there. But then we're going to wait. Okay, what's going to happen this week after the ADP report? Well, we're supposed to be having jobless claims, or we're supposed to having non-farm payrolls. We're supposed to having average hourly work week, average work week. Do we have those? No. Because the Bureau of Labor Statistics, like, we're furloughed, bitches, we ain't giving you nothing. So we don't know. The market's speculating at this point what those items are. We do know also that Bureau of Labor Statistics has traditionally showed something different than what ADP is showing, and there is some cooking of those books. I'm wondering where things are going to land. So let's look at the market itself. It is right now just kind of sitting, I wouldn't say stagnant, but it is a bit stagnant from where it was. It has come down just a tad from where it was. So there's where we sit presently. We'll see how that all plays out because it is off a little bit off of its highs. It's not where we were previously, but it's actually it's still holding in this range, this middle range that we talked about, which is where the quantitative easing announcement and the end of days trading. So it's holding right in the middle of that. Now, is it possible for us to see a jump above it? It's possible. What's happening here that's making that possible? We have, again, this is the day they started quantitative easing. What makes that possible or make it something that's going to be a little difficult for it to hold is the fact that they're talking about continuing quantitative easing. That is a continued conversation. Now, I showed you in the charts in the last video that we did that there is a potential that they're going to do quantitative easing because of the fact they're backing off on their quantitative tightening. You also have there's a lot of rumblings about what's going on in the market and the economy, what they're trying to do. They're trying to literally destroy the US dollar and force it more into a digital currency and make a digital currency the global reserve currency. That is being discussed all over the place. It's everywhere. If you're not seeing it, it's because you're not paying attention. So if that is the case, and they use quantitative easing to destroy the dollar, and that could drop the rates, guys. Don't wait for that to happen, though. If you're sitting here waiting, say, oh, they're going to drop the rates. Aaron said that they could see this go up and quantitative easing kicking in again. That's to destroy the US dollar, guys, and get us onto a different reserve currency. And if it does happen and it gets that drop, what do you think the price of the house is going to do? We just talked about a deal right now that could be worth about 300 and whatever thousand, right? 380,000. What if they dropped 1% on those rates? The demand increases significantly. We've seen it before. This is not some idea that I came up with. It's actually proven time and time again. We have a finite resource or the finite number of these assets in these single family houses. Why do you think the hedge fund's been buying the piss out of them for so long? There's only so many. They're not building more. They're building more apartments. Now, there are some larger box builders that are building out there, a lot of big builders. And you should follow some of the inspectors in those areas. They're finding those are so shittily built. You don't want to buy those as an investor. You're going to be working on it forever. It's not worth buying. Get some with great bones that's well rehabbed, or a new construction in some of these areas where it's a smaller builder that takes real pride in the work. Because the big ones, they ain't. They're doing a pretty pissy job. You can look it up yourself. Do your own research. I'm just going off of opinion here. So that being the situation, if they do quantitative easing and you're not in the deal now and you're waiting for rates, you're only cutting your own throat. Getting a 1% drop in an interest rate to get an extra $100 in rent is going to be way less profitable than jumping on it now and letting it jump up 12%, because you're going to pay more for the house. And sometimes you put more out of your pocket because it won't appraise fast enough because we won't have the closings to bring the values up. So you have to put it out of your pocket. So you're investing more for a lower return, and you're not going to get the return you think. You got to work these numbers through, and it's not about the damned rate. When you think it's about the rate, you become a slave to the banks. If you don't understand that, you got to reach out to me. Just info@aaronchapman.com. email me, info@aaronchapman.com. We'll talk about it. We'll do a little long math, and I'll show you how waiting for the rates is a complete fool's errand. Now, one last thing, because you guys need to be doing this, signing up for this, the Real Estate Investor Summit, REINVestorSummit.com/ACH is how you register for that. Free online event. I will be on this thing 2 days and 20 hours. You'll see me giving you some data, a lot of what we talk about here, but it's all going to be condensed into one place. Appreciate you guys, and I'll talk to you on Tuesday.